everyone. Thank you for attending the Place Your Trades Network Spaces. This Spaces is brought to you by Traderate, which has a custom web app dedicated to trading CME Group's new daily option contracts, including indices, energy, metals, and now Bitcoin. You can now trade these on the DOM, on Traderate's main platform as well. They're a great way to get exposure to the futures markets with limited risk. Go to placeyourtrades.com and get the Traderate app for free. They also write a weekly blog and daily pre-market overview on the markets that you can subscribe to at placeyourtrades.com. I will be doing a summary of this episode with my key takeaways that will be available to download as a PDF. So if you're interested in getting this PDF, please click on the link in my feed or visit placeyourtrades.com/spaces to sign up for it. I'll also put it up in the Jumbotron, and the PDF overview will be available and emailed out to anyone who signs up. And before we begin, I just wanted a reminder, this material is presented for solely for informational entertainment purposes only and is not to be construed as a recommendation, solicitation, or an offer to buy or sell long or short any securities, commodities, or any related financial instruments. Please contact a licensed professional before making any investment or trading decisions. And with that, I will introduce our guests, which absolutely don't need an introduction, but just in case, we have Danielle DiMartinoBooth, my friend. Danielle is CEO and Chief Strategist for QI Research, a research and analytics firm, a global thought leader in monetary policy, economics, and finance. DiMartinoBooth founded QI Research in 2015. She is also the author of Fed Up, an insider's take on why the Federal Reserve is bad for America. As a business speaker and a commentator, she is frequently featured everywhere. Prior to QI Research, DiMartino spent 9 years at the Federal Reserve Bank of Dallas. She served as an advisor to President Richard W. Fisher throughout the financial crisis until his retirement in 2015. Her work at the Fed focused on financial stability and efficacy of unconventional monetary policy. Danielle began her career in New York at Credit Suisse and Donaldson, Lufkin and Jenrette, where she worked in the fixed income, public equity, and private equity markets. Next, we have Danielle Lacalle. Danielle's a PhD economics and fund manager. He's also the author of best-selling books, Freedom or Equality, Escape from the Central Bank Trap, The Energy World is Flat, and Life in the Financial Markets. He's also a professor of global economics at IE Business School in Madrid, which ranked one of the top most influential economists in the world in 2016 and 17 by Richtopia. He holds a CIIA financial analyst title with postgraduate degrees in higher business studies and a master's degree in economic investigation. He is also a member of the advisory board of Rafael Del Pino Foundation and commissioner of the Community of Madrid in London. So thank you both for coming again today. With that, we'll start. We'll do this in 2 rounds, and then the final round will be a final thoughts round. And as always, if you want to comment on each other's comments, please feel free to do so. We can make this as roundtable as we want. And with that, I will start with Danielle. So I kind of want to start with the health of the U.S. consumer. It's kind of been our focus this month. And we're seeing a rise in delinquency rates. It's coming from almost all-time historical lows. That said, the rate of change is rather steep. So what are your thoughts on this, and should we be worried?
I do. First of all, thank you for having me. That was quite the introduction. And early on, I'll say happy Thanksgiving to all. But yes, it's with good reason that we are finally at the precipice of being concerned about the U.S. consumer. People don't appreciate that it was just a matter of 3-4 months ago that the employee retention credit, we all recognize the TV commercials that have been on all over the financial media, Kevin O'Leary, et cetera. It was just July that $30 billion of cash was pumped into U.S. household accounts. It's just a matter what's the 22nd of November. In 8 days, there are going to be some FHA borrowers who are going to be coming off of forbearance that's been in effect since March of 2020. Student loan payments have resumed. It's been a nothing burger except for those actually making their payments. And we know that that has increased appreciably, and we're beginning to see the fallout, despite where stocks are, mind you, of higher end consumers beginning to step back, beginning to see the writing on the wall, because we've had a sufficient buildup. I'm going to share some data that I haven't shared anywhere in the unemployment rate cycle. In past cycles, when you have 50 states or more, 50, that includes the 51st of Washington, D.C. But in past cycles, going back to 1976, when we have state unemployment data handy, that when the series was born, we've been in recession. In past cycles, the month that follows 50 states having rising unemployment rates, which would be the month of October, in every single instance, without exception, we've seen a negative non-farm payroll print. In every single instance, we've seen the unemployment rate at a national level increase. That would be going to 4% or more in this next non-farm payroll report. The Bureau of Labor Statistics is borderline USSR era type of monkeying with the data. So we might not see it until revisions come out in a month or two. But my point to you is, I think most Americans are well aware that the recession started in October, and they let the sell side sit around and debate whether or not there's going to be a soft landing. And they're the ones buying the popcorn. But the gig is up. And I think people know it. It has to do with the fact that the U.S. government on a marginal level will not be directly depositing cash into household bank accounts. It's all that matters, folks. You can talk to me about the CHIPS Act all day long, the Inflation Reduction Act all day long. That's not cash to consumers. That gig is up until March of 2025. It's why we're going to see inflation come down. All that sticky BS is going out the window, and why we're seeing layoffs continue to increase.
So I take it you're in the hard landing camp.
I think recession began in October of 2023.
Okay, fair enough. I want to move over to real estate for a little bit here. You've posted quite a bit on real estate lately. Everybody kind of knows the commercial real estate is somewhat of a disaster. That's been ongoing for months, but let's talk a little bit about residential real estate. Residential real estate has remained pretty firm despite the explosion in mortgage rate. Is this the next shoe to drop, so to speak? Meaning, are we starting to see sort of cracks in this market as well? And what should we be looking at in this market?
So we have indeed started to see cracks. Bank of America put out an interesting report at the very tail end of last week that said of the 97 major metropolitan areas in the United States, it is cheaper to rent in 95. So 95 of the 97 major metros in the United States, with the exceptions of New Orleans and Jackson, Mississippi. In the event you want to go buy a home there, go for it. Otherwise, the supply-demand imbalance is going to continue to get worse. We're seeing this in multifamily delinquencies. We're seeing multifamily feed into home price pressures. We're going to continue to see that. If you recall, it was a lack of multifamily that helped accelerate the increase in home prices post-pandemic. So we're seeing a reversal of that trend. And from what I'm hearing via my friends in the trenches, the Airbnb jocks are having a very hard time trying to get out of some of these mortgages. So we're starting to see, Redfin tells us that we've got a 6-month high in existing home inventories. And we know that many major home builders are holding off until the end of this month to put that last doorknob on single family homes, so that the clock begins after their fiscal year ends on paying property taxes. So there are many different confluences of events. People who assume that because this is not a subprime 2.0 means that there's no leverage they're barking up the wrong tree. They're not appreciating the fact that you don't have the magnitude of home price appreciation that we've seen absent some kind of leverage, and lots of it. It's just taken on a different form. But I've spoken too much. I want to hear from the other Danielle.
All right, so we'll move over to Daniel. We've got Daniel and Danielle. I have to enunciate better. So, Daniel, let's talk a little about my favorite topic, CBDCs. IMF just came out and said that the public sector should keep preparing to deploy central bank currencies and related payment platforms in the future, and this is no time to turn back, which in my opinion, should frighten everybody. But a lot of people don't really understand the inherent dangers of a CBDC, or even understand how CBDs actually work. Often the argument is, well, we're in a digital payment system now anyway. What's the difference? So can you kind of dive into this a bit? I know you've done quite a few videos on this. And kind of maybe explain CBDCs a little bit for people that don't really know. And then, is there any way to escape this, or is this our ultimate fate?
Okay. Well, thank you so much for inviting me, Tracy. It's an absolute pleasure to be here, also with my good friend Danielle. It's a privilege to join this conversation. And thank you so much for the introduction. I'm about to hire myself after such an illustrious CV. Well, central bank digital currencies are often confused with electronic money. We all understand electronic money, and many people think that what is going to be the difference at the end of the day with electronic money, all our movements can be traced, and the bank knows exactly what we're doing. So what is the problem of having your currency in digital form with the central bank? First, electronic money and digital currency of a central bank have absolutely nothing to do. Electronic money is currency the way that we know it, and the transmission mechanism of monetary policy goes through the credit system and has a number of backstops precisely because of credit demand. Central bank digital currency would be having your savings and all of your payments done in the central bank, and therefore the central bank will know everything that you are doing with your money, from spending to saving. And central banks don't like for citizens to save. So central bank digital currencies will have a very distinct feature that your currency doesn't have, which is that they will be programmable. And being programmable means that the central bank can put a sort of sell by date, some kind of validity to how long you can have that cash in as a deposit in your account. And obviously, that creates very, very significant risks. First, because if the central bank creates too much money, it can easily decide to take it away from your account if you have been the crazy one that decided to save it. Second, because being programmable means that it creates very perverse incentives to the first recipients of money. Third, because the central bank, and obviously they will not say that they will do this, but they will, can decide who to penalize and who to give a reward in terms of how they spend and where they spend. In the case of the European Central Bank, they have already created a digital ID which will have a carbon footprint wallet. So the central bank may deduct your carbon footprint out of your expenses and basically limit your travel availability, your mobility, etc. A central bank digital currency Many people say it's the same as electronic currency. We're being monitored all the time. Everybody knows what we're doing. This is the SWIFT system. This is what credit cards do and commercial banks do. No, my friends, it is not the same. And I always use with my students the following example. It is not the same to have a policeman in your neighborhood wandering around the streets than to have a policeman in your kitchen. And that is what a central bank digital currency is, having a policeman in your kitchen that can decide what goes in the fridge and what goes out of the fridge.
So is this ultimately coming to fruition and we're all kind of screwed, so to speak?
It is certainly coming to fruition. It is almost inevitable. And let me start also, and let me add one thing. There is absolutely no need for a central bank digital currency. This is the most important thing. In the current monetary system, and Danielle knows very well as well, there is absolutely no need for a central bank digital currency unless the central bank wants to impose its market share on citizens and enforce it through repression instead of like it is today, because we prefer to use the dollar or the euro relative to a local currency or something else. And finally, you mentioned before, if we can escape from this, well, you can. Obviously, those that have access to hard assets and those that have access to different forms of money.
Oh, I think he just cut out. Oh no. Hopefully we can get him back. I hope. So we'll go back to Danielle while we're trying. Oh, are you back, Daniel?
Well, he certainly scared the heck out of me.
I see he was connecting. Are you back, Daniel? Hello? All right.
Tracy, while he's getting back on, I would just like to add that a lot of people on Twitter accuse me of being a shill for the Federal Reserve. A, I'm not, but B, so that I can further solidify their suspicions, I will say that one of Jay Powell's, other than higher for longer and trying to break the back of the Fed put, which I believe he's trying to do, I don't think he's worried about inflation, but I think it provides him good cover. But I think that one of the other redeeming characteristics of Jay Powell is that he's not an advocate of central bank digital currency at all. And the new people, the two new people who have been confirmed for 14-year terms, that was one of the least reported stories in the media in 2023, was that there have been two new appointees to the Federal Reserve Board, both of whom would advocate for central bank digital currency. I think that proponents of CBDCs feel as if it's just a matter of waiting Jay Powell out. And that's kind of how they look at things. That's how they see the world, is we've just got to wait till Jay gets out of office so that we can proceed forward with Ken Rogoff's biggest dream of installing Big Brother in every American's kitchen. I'm about to go check my refrigerator, for heaven's sake.
With that, that's good news that Jay Powell doesn't like central banks. But what happens when
currencies? No, he's right. Yes.
All right, we have Daniel back.
Sorry.
All good.
Yeah. So no, I don't know where my line was cut. It was probably done by the European Central Bank. So I'm really sorry. But the final point that I was trying to make is that those that have hard assets and those that have access to ways of managing their savings in independent currencies will have more relative freedom than the ones that have only a salary and deposit savings. The ultimate goal of a central bank when they are trying to manage excess savings which is a completely ludicrous concept from an economic standpoint that they often repeat. But the ultimate objective is that if they print too much money or they print too little money, is basically to adjust the quantity of money via the amount of savings and deposit savings, which is the way in which the vast majority of citizens tends to hold their little precious savings, is the main goal to access.
And then the next question is we need to talk about de-dollarization. That seems to be a huge topic of conversation lately. So it's a kind of a two-part question. There's a lot to talk about de-dollarization. So can I first get your thoughts on this and the reality of the global dollar scarcity problem right now, and then kind of your thoughts on a BRICS currency and if it's possible.
Mm-hmm. Okay, de-dollarization. De-dollarization is not possible today. It is not possible either from a fiat currency or from a cryptocurrency, because the dollar right now is the global liquidity provider, both for cryptocurrencies and for all other emerging market currencies. Secondly, because you cannot dethrone a world reserve currency by having all of the negatives of the previous king, the dollar, and none of the positives. It is impossible to have a world reserve currency like some have mentioned with a joint BRICS currency for a very simple reason. Two of them have massive capital controls, and the four of them are actually extremely weak currencies. So I actually, every time that I hear this concept of the de-dollarization by thinking that Brazil, Russia, India, and China are going to get together, I always compare it to having the Beatles with four Ringos. It makes absolutely no sense whatsoever. And it makes no sense whatsoever. And there's one question that I make to everyone that talks about this de-dollarization process, which is, would you have your salary in that currency and your savings in that currency? And the answer is no. And the answer is no. So the dollar remains the world reserve currency because there is no alternative. And because it's not just how strong your financial system is, which is important. It's not just how liquid your currency is, which is important. It's also a matter of legal and investor security. So it is impossible to basically dethrone a world reserve currency with a currency in which there is no legal and investor security, and in which there is certainly the capital controls. Nobody's going to accept, anybody here in our chat listening would accept to conduct trades in a currency with capital controls. So,
Danielle,
no, I
you
don't
get
see.
extra portions of turkey at my house for putting the right answer out there. Very well done.
Thank you so much. I would absolutely love to join you for Thanksgiving. It would be a phenomenal conversation, and we would have a lot of fun. Yeah, so that's basically why I see there is absolutely no possibility right now. And actually, if the European Central Bank makes the mistake of implementing the euro digital currency first, then the dollar will not just continue to be the world reserve currency, as long as Mr. Powell, as Danielle says very well, continues to be there, would not just continue to be the world reserve currency, but what we will see is not de-dollarization, but de-eurization, if that word ever existed. I just created it.
I like it. Right. Thank you. All right. So we'll head on back over to Danielle. I had a question on, let's talk about rate cuts. right? So the market seems to be pricing in Fed rate cuts as early as June 2024. Yet Powell has not wavered from higher for longer. So your thoughts on this, and is the market wrong?
Well, I mean, this is only the seventh, 7th Powell pivot that we're on right now with markets pricing in. And you know, with the hats off to all of my Twitter followers who are equally vehemently convinced that this pivot's going to be the one, because I want to, whatever they're drinking, I want to double, because their enthusiasm never dissipates that this is going to be the one. I will give this much to Powell. He is a master at his craft, at talking markets out of their preconceived notions. He's done it over and over and over again. And we know that that is going to be possibly the case come next year. Look, there are a lot of inflation readings. Shelter inflation comes down very slowly. He has dispensed with shelter inflation's efficacy in terms of what he follows. That if he wants to change the conversation back to focusing on shelter because it comes down at such a glacial pace, in order to hide behind that to maintain higher for longer, he'll do it. And moreover, what people don't focus on enough, namely because in the defense of the press pool, they're gagged. They're really not allowed to press Powell when it comes to the subject of quantitative tightening. But because he's already said, even if we start to press through with rate cuts, we will still have quantitative tightening going on in the background. I suspect that that on Friday afternoon, when the Federal Reserve's H8 is released at 4:30 Eastern, that we're going to see other deposits liabilities, which my mentor Lacey Hunt has taught me to track meticulously week in and week out. I suspect we will have seen a nearly $17 trillion figure decline to south of 15 trillion, that milestone, for the first time. This continues to be very impairing for the economy. We saw the largest decline in commercial and industrial loans last week since March. I will remind you that there was a banking event in March. So even if we begin to contemplate rate cuts in the summer of 2024, there won't be many of them. He won't do anything major right in front of a national presidential election. And he will continue to try and reduce the size of the Federal Reserve's balance sheet, which is manifesting in the most robust bankruptcy cycle that we've seen since 2010.
And then on the 2% inflation rate goal for central banks, do you think that the Fed and other central banks, for that matter, can reach that 2% inflation rate, or are they going to have to accept higher?
I actually think right now that what we're seeing with the massive supply coming online in apartments, and that the ability to get the first month free, the last month free, a lot of renters right now, if they're not getting concessions from their landlords, they're like, goodbye. I'll move. And we're seeing a lot more of that. So I think that the pressure that we're going to see moving forward on home prices is going to accelerate shelter disinflation. We've already crossed the Rubicon into core goods deflation. We've begun to hear from the airlines and from other travel companies in the travel space that travel's slowing quickly. So we're seeing a manifestation on service inflation come down quickly. And Tracy, you can tell all of us what's going on in terms of global demand for oil, and the fact that there is we don't just talk about markets in the context of the supply to the markets, but the context also equally of the demand for something. So the energy aspect that's been problematic for the CPI is coming down. One last thing, by the way, is because food is 4 times the weight of energy in the CPI. My go-to anecdata is that we get the old-fashioned physical newspaper delivered to our home every day. I look every single Wednesday at the thickness of the local supermarket ad circular, the weekly ad. At the peak of inflation, when it was pressing 10% year over year, that ad circular was 1 page front and back. It's 6 pages now. And I can get Oscar Mayer bacon for $3.99. I just picked up butter for $2.49 a pound, and Granny Smith apples to make an apple pie for 79 cents a pound. So food inflation is also something that is not going to be concerned. The bigger boogeyman for Jay Powell is when somebody wakes up and sniffs the deflation. Against that, with this high debt backdrop, he is powerless.
And then moving on, I want to move on. I think I need to move to Texas. Those prices sound pretty good. They haven't hit here in Florida yet.
I filled up for $2.05 a gallon a few days ago because I use my supermarket. Every $100 I spend, I get 10 cents off. So $2.05. I filled up my gas tank. I felt very good.
Well, yeah, that definitely hasn't hit here yet. But I want to move over to the labor market here for a little bit. I want your thoughts on the labor market in the U.S. and why has it remained so resilient? And what does this mean for the Fed as far as what they're going to do? Because we know that they're trying to break the labor market a little bit. So is this forthcoming? And talk a little bit about the state of the current labor market as it is right now.
So it's interesting, Tracy. The labor market in the United States is strong, but it's strong in air quotes. And I think we have to be very cognizant of the fact that continuing jobless claims have gone up until this last week. 8 of the last 9 weeks, they stopped going up in the latest week, which is it's monkeyed with a little bit by the holiday effect. But in September of 2022, that's not too long ago, there was not a single state with rising continuing jobless claims. Right now, there's one state left, Kentucky, that does not have rising year over year continuing jobless claims. That is the ranks of Americans collecting unemployment benefits. It's up 27% year over year. The percentage increase in Americans who've been unemployed for 15 weeks or more, according to the latest jobs report, is that's up 28%. Usually you have to be at 15% to be looking in the back in the rearview mirror at being in recession. And as I mentioned earlier, we've never had 50 states, 50, with rising unemployment rates without having been in recession, without exception. We've always had a negative non-farm payroll print the next month. And I think, again, I will reiterate, if we were to be having this Twitter Spaces, call it in 3-4 months, the discussion might be revolving around, hey, what's Powell going to do? Because now that the labor market has begun to deteriorate in earnest and visibly, and inflation's coming down so quickly, now he's going to be pressured in an election year to go to push through great big rate cuts and quickly.
Thank you. We'll move over back to Danielle. So I want to talk about energy here for a minute. It seems oil is kind of higher for longer. I mean, even in the, even with, Brent in, what did we say? Still almost at $80, crude at $74 right now. That's still a lot higher than historical norms have been. And then if we look at renewables, we're seeing that those big projects can't really survive outside a world of NERC, right? We just saw Ørsted and Siemens, the gigantic problems that they had and the projects that they've had to cancel because costs were too high. So where does this leave us exactly? And obviously, this is not ultimately in the inflation metrics for central banks, but since you can't really do anything about energy and it's the single largest expense for most businesses, how does this at all affect central bank policy?
Well, if we look at energy, I think it's very interesting to see how we see the market moving on the one hand with the reality of demand growth that is weaker than expected because of all of the challenges that we just mentioned, and supply tightness that maintains a elevated level of, let's say, of the minimum price that we are able to accept for oil. So what we have seen is how the the resistance level is not necessarily kept throughout the period because of the weakness in demand. But on the other hand, what we have is a floor that keeps being higher, and we have seen it in the 3 consecutive periods. I tweeted that this morning. So I think that is one important factor, because what is showing is that all of those disinflationary processes and all those disinflationary pressures that we are seeing all over the place, as Danielle was mentioning, are literally the reality of monetary aggregates coming down. What we are seeing, we are going to see disinflation, and very quick disinflation. And remember that disinflation is a reduction in the pace of increasing prices, not a reduction in prices. We are going to see disinflation because monetary aggregates are collapsing. And monetary aggregates will likely collapse even further next year because we have the wall of maturities. And the wall of maturities means that the United States federal government is going to refinance around $7 trillion, which means that on top of the tightening that Danielle was mentioning, we are going to have $7 trillion less of liquidity in the market. So commodities cannot go up in terms of annual increase in that environment, but commodities do not go down, which is exactly what you just mentioned, to the levels that we would consider dangerous, or dangerous for the suppliers and consumers. So it's basically just hovering around this between $72 to $80 level. In terms of oil, geopolitical concerns, tight supply remain, obviously, but there is likely to be a much larger force impacting inflation, the different inflation components, which is the monetary contraction. And if we look at the monetary contraction, it's very severe. But the reason why we have not seen much lower inflation, if you look at monetary aggregates, by now, the United States should have between 1.8 to 2% inflation, not 3 and a bit. And the reason for what the Fed calls sticky inflation is that if you look at monetary aggregates published by the Federal Reserve, yes, M1 has fallen. M2 has fallen from 22 trillion to 20. Yes, all of those have come down. But the window of liquidity of the Federal Reserve has multiplied by 10, from 20 to 220 trillion. So all of those factors are what is making the lag effect on inflation not appear yet. Right now, it's still what the Fed. I don't understand why a central bank doesn't pay attention to monetary aggregates. Well, I can understand why they don't do it, but it's insane.
Danielle, it's very inconvenient to pay attention to them, so they don't.
Of course, you got it. You got it. Absolutely. So that is what is going to happen next year. As Danielle is mentioning, all those things are accumulating, and they will come up in the data that the Fed publishes and makes people look at, which is all lagging indicators. Danielle is talking about leading indicators. We're talking about leading indicators. So all of those lagging indicators the unemployment rate says absolutely nothing about the future, and let alone about the strength of the labor market. No, so those will appear in 2024.
And then I kind of want to switch this to the EU for a second, kind of about the whole state of the EU. It seems, if we look at, say, energy policy, Germany in particular, it seems Scholz is holding steady to no nuclear stance, right? And thus we're seeing a rapid deindustrialization happen in real time in response to the higher energy costs in the EU. So where does this leave Europe?
this leaves Europe in stagnation by design. In stagnation by design, because only a politician can make such an absolutely abominable mistake like shutting down most of the nuclear fleet and deciding in the middle of an energy crisis to shut down the remainder of the nuclear fleet. That can only happen in insane politics, and obviously in even more insane politics like in the European Union. So if you think about it, the European Union is losing competitiveness because of energy policy. I just heard Danielle saying how much she paid for gas, and I'm crying, because I pay 50% more, not 50, double, huh? So what is happening basically is that the European Union, being an importer of energy, does not see the benefits of low price natural gas, oil, or coal because of the massive level of taxes, 50 to 60% taxes on energy. And at the same time, it's losing competitiveness because of the energy mix, because renewables, with all of the good things that they have, are intermittent and volatile. So it's absolutely insane to see that a country, due to allegedly environmental decisions, shuts down the nuclear fleet and then proceeds to depend even more on coal, which is the problem of Germany right now. So the deindustrialization is a de facto process that is almost by design, because it's impossible to increase the participation of industry with all of the regulations, the taxes, and the energy policy. And the energy policy is basically one of the pillars of the reasons why the European Union is in almost structural stagnation, because it's not just demographics, very important. It's not just the energy policy, very important. It's not just the taxation policy, which is huge and very important, but it's also the fact that the current recession is happening in the middle of two gigantic stimulus. One is indirect, which is low commodity prices, because it's an importing economy. The second is that very few people are saying that the European Union is in recession in the middle of the largest fiscal stimulus package of all time, the Next Generation EU plan, which is an absolute disaster in terms of its results. So the European Union does not have the technology that the United States has or that China has. It doesn't have the demographics. It doesn't have the competitiveness in terms of energy, and is certainly, therefore, uh, throwing away not just industry, but also the primary sector. I'm going tomorrow to the Netherlands, and it's atrocious what they're doing with agriculture.
Oh, I can't even, it's horrible. Just in
Well,
general.
I would just add to the irony here. I obviously don't have a place to speak about the recession, but I will say that the phenomena of the media ignoring the on again, off again recession in the third largest exporting nation of Germany is something extraordinary to behold in terms of the mainstream media. And the other thing that I learned the last time that I was in Paris is that Paris is sitting on top of one of the largest shale formations on planet Earth. I
Yeah.
find this whole thing to be highly ironic and tragic for the people of Europe.
Oh yeah, not just the if the European Union decided to develop its natural resources the way that the United States has done, by the way, reaching all-time highs in oil production now, um, all of these issues would be significantly different. But what is interesting is that when you go to Paris, when you go to France, when you go to Germany, when you go to Poland, is that there seems to be some kind of pride of thinking that it's a great idea to ban the development of our own natural resources and import liquefied natural gas from the United States at not three, sorry, at 5 times the price.
Well, the six largest banks in France have signed a pact to not develop that shale formation. You say that to somebody from Texas, and they look at you like they've got three heads.
Yeah, and you know why? Because there is a huge difference between the United States and Europe. Is that what is underground your home or your property in the United States is yours, whilst in the European Union it is not. Therefore, though the owners of land don't have any incentive to prefer to develop natural resources because they will only get the negatives. But what I find amazing is what you have just mentioned is also that the European Central Bank and regulation policies is that banks are tilted to avoid financing anything that has to do with fossil fuels or with mining and to finance everything that has to do with renewables. But at the same time, financing renewables without financing mining in copper, in rare earths, in lithium, etc., makes absolutely no sense. So what the European Union is doing on top of it all is going from depending on Russia for natural gas to depending on Russia, China, and Chile on metals and on everything that is mined. It's just ridiculous.
And Danielle, I wanted what, because Danielle was speaking about, the fiscal policy stimulus in the EU. So what are your thoughts on, Danielle, what are your thoughts on the fiscal policy seemingly butting heads with monetary policy in the United States? And particularly heading into an election year, is the Biden administration going to put pressure on the Fed and Powell, because they can't really have a recession going into elections, or they want to avoid one as best as possible.
So here's the distinct irony of the Biden administration buying time one too many times. It's that the clock is running out, and heading into the teeth of an election year here with effectively 11 months left of campaigning, there's nothing that they can do on the fiscal side to rescue the U.S. household, because he's executive ordered in as much as he will be allowed to executive order in. So now is when the consumer's left floundering. People are like, but wait, all this deficit spending, this percentage of GDP. I'm like, pork belly spending does not transmit directly to U.S. consumers. It does not transmit directly to U.S. household spending. And this is a huge, huge problem for the Biden administration, because Powell's just going to sit back and say, get your fiscal house in order. I'm not going to be the ultimate enabler, who my three predecessors were, and bring down the Fed funds rate just so you can continue running these fiscal deficits. And he's got a much stronger leg to stand on, because disinflation is going to be the commanding driving factor in the background, not inflation.
And then I wanted to talk about the latest B of A fund manager survey. And the monthly survey showed that investors were dumping cash to hold the biggest overweight position in bonds since 2009. So, what are your thoughts on the bond market at this point? Are we going to continue to see yields rise, or do you think they are going to come down more?
So, my institutional clients thought I had seriously just gotten a lobotomy, because I said that we were going to see long rates fall, and I said that the idea of coming full out of a steepener trade was premature because of higher for longer. We had to test Powell's mettle, and that had not been done yet. I said, so don't be surprised, don't be shocked if we reinvert, and we're at negative 50 right now on the 2s, 10s, even though you're seeing long rates fall, which is indicative of recession. And lo and behold, here we are. So I've been joking for a long time. Got yield? Kind of like got milk, got yield. Right now, investors are like, I got your yield and I got it right here.
One last question for Danielle, and then we'll go to the final round. I wanted to talk about, actually, first, you had a Twitter question. It's from, I forgot his name, but this is a Twitter question. Should Javier Milei's newly elected administration in Argentina follow through and dollarize? What will be the short and long-term impact, if any, to their economy and to the value of the US dollar?
Okay, should Argentina dollarize? Let's start from understanding that Argentina does not have a viable currency. Argentina has a failed currency. So the economy is already 70% dollarized. When you go to Argentina, you can see it. No? So dollarization is inevitable because I don't know if you know, the people that are listening, but the central bank has net negative reserves. It is insane. Net negative reserves. So the central bank is bankrupt and the currency is completely failed. So it has to dollarize. But dollarize means ultimately fiscal adjustment. That is so therefore there will be pain first because the official exchange rate of the peso is about half of what the real rate of the peso that you can exchange in the underground of Buenos Aires. So there has to be some pain first, and significant, as it happened in Ecuador, and then what you have is an improvement. Dollarization or euro, it doesn't matter. It's basically just recognizing that you have a failed currency, and the positive impact afterwards is evident. So it has to be done. It's inevitable.
And then so you think that they'll be able to do so?
Oh, absolutely.
In other words,
Absolutely, they're able to do it. But by the way, it's not that they're able to do it, is that anybody that has traveled or lived in Argentina knows that no Argentine citizen saves in pesos. No Argentine citizen conducts mildly significant transactions in pesos. So the economy is already mostly dollarized. The only thing that you need to do in order to dollarize is to adjust the budget to reduce government spending, because the reason why they print so many pesos is because the government spends way too much above what they collect. So the way to do that basically is to understand the Argentine budget. And we all talk about fiscal imprudence from the United States or the European Union. But if I tell you guys that 25% of the Argentine budget is impossible to know where it goes to, that it's all gone to political spending, that it has absolutely nothing to do with essential goods and services or essential social activities, then you would understand why it's possible to bring the fiscal deficit to zero and then bring the trade deficit to zero or to a surplus in a country that has everything that the world demands, but it's limited by regulation and legislation. So dollarization is fully acceptable.
okay, and then I had a question on base and industrial metals and energy transition minerals. So we've been seeing weakness in commodity prices across this sector, yet supply is rather tight in many of these markets, and we still have this big push for, say, for renewables, particularly the EV market. So why do you think this is happening?
Because of monetary tightening. Because we investors in energy spend a lot of time, and rightly so, talking about supply and demand, and that makes absolute sense, and that's it's an important part of the analysis. But we forget that if rates are rising and money supply is coming down, commodities are not going to react positively in the short term. No, so we need to understand that the monetary policy tramples over supply and demand in the short term. Also, if you think about it from the perspective of what would be a long duration asset, a commodity is a long duration asset, it's absolutely logical that the spot price suffers in monetary contraction periods. So that's what we need to look at. I explained it in the energy world as well.
if I could jump in for just 2 seconds, I think that there's a separate elephant in the room, and that's that in 2015, 2016 global industrial recession and coming out of the great financial crisis, that China was an enormous buyer of the market that you're describing right now. And they're on their knees right now.
Absolutely. Absolutely critical.
Excellent. Thank you. And now we'll move to the final round, and it's the same question for you both, and we'll start with Danielle. First, you can talk about something that you wanted to cover, but we didn't get a chance to cover today, or what should we as investors be particularly paying attention to over the next 12 to 24 months?
So I think two things really, and that's do not stop paying attention to Washington, D.C. The lack of marginal helicopter money directly to households is absolutely critical. And the other thing that I would draw your attention to is Danielle brought up the idea of this massive refinancing that's going to be hitting the United States economy in 2024. There's also the WeWork effect. And I think we have to be cognizant of the WeWork effect accelerating the commercial real estate unwind at a time when the clock turns from 2023 to 2024, commercial real estate's actually going to be subordinated to refinancing in the corporate bond market. In other words, if we think that commercial real estate yields are high right now, just you wait until high yield bond refinancing subordinates commercial real estate for bank balance sheets. So I think people have to be thankful almost for what happened with WeWork, because the window of price discovery being as friendly as it is, as awful as the recovery rates are, is going to be less friendly. And by the way, I'll push this off to Daniel. This commercial real estate unwind is a huge global phenomenon.
Yeah, I completely agree. I think that what I would say to all investors is pay attention to what's happening with monetary aggregates at a national and an international level, because that is basically what is going to tell you with a lag of 9 to 12 months what is going to happen in the global economy. So I would add only that to the extremely important issues that Danielle was mentioning.
Excellent. And with that, I want to thank you both very much for spending your time with us today. I know that you're very busy people, and I know that I really appreciate it. I know our listeners really appreciate it. Please follow both Danielle and Daniel. They offer a lot of great information on their stream if you're not already following. Also follow Place Your Trades to see what else they have going on over there. Again, thank you both very much. And with that, I will see everybody next Wednesday.
Thank you, Tracy, for your time. Happy Thanksgiving, all.
Happy
Thank
Thanksgiving.
you, everyone. Thank you, everyone. It's been an absolute pleasure. Thank you, Danielle. Thank you, Tracy. Happy Thanksgiving.
Thank you.